Two Australians earn the exact same salary, save the exact same deposit, and walk into the exact same bank. One buys a suburban house with a 30-year anchor around their neck. The other rents an apartment down the street and dumps their spare cash into the stock market. 7 years later, their net worths tell a radically different story. If you've ever stared at a real estate app at midnight, watched housing prices rocket past your savings rate, and felt a cold knot of anxiety in your stomach, you're not alone. We are conditioned to believe that buying property is the ultimate milestone of adulthood. But what if the sacred Australian dream of bricks and mortar is actually a financial trap disguised as security? By the end of this video, you will possess a clear, bulletproof mathematical and psychological framework to decide whether renting or buying is the smarter move for your future, and which path secretly locks you into a golden cage. Australia has an undeniable love affair with real estate. It dominates our weekend dinner table conversations, dictates our political cycles, and shapes our entire perception of personal success. For generations, the formula was simple: get an education, secure a stable job, buy a piece of land, and watch your wealth grow safely into retirement. Yet, as housing affordability reaches historic extremes across Sydney, Melbourne, Brisbane, and beyond, that traditional formula is fracturing. A new generation is waking up to a complex reality where the cost of entry is staggering, and the hidden liabilities of homeownership are frequently swept under the rug. But is the alternative renting for life and investing elsewhere actually a viable path to freedom? Or is it a fast track to financial vulnerability in your later years? To find out, we need to strip away the cultural noise, look past the emotional hype, and examine the raw financial and lifestyle mechanics of the Australian property market. The pressure to buy a home in Australia starts long before you ever look at a mortgage calculator. It is baked into our cultural DNA. From an early age, we absorb the golden rule handed down by parents and grandparents: stop paying off someone else's mortgage and buy your own patch of dirt. This generational expectation transforms property ownership from a mere financial transaction into a profound psychological rite of passage. Not owning a home by a certain age can make you feel like you are falling behind in life, failing to secure your future, or somehow wasting your hard-earned income. This cultural obsession didn't happen by accident. Over decades, the Australian housing market evolved into a protected economic religion heavily supported by government policy. Mechanisms like negative gearing and capital gains tax discounts turned residential property into one of the most favored asset classes in the country. Investors and owner-occupiers alike flooded the market, secure in the historical belief that Australian real estate simply does not go down in the long run. This creates an intense emotional weight. Every milestone marriage, children turning 30 comes bundled with the unspoken mandate to secure a home loan. But here lies the critical question we rarely stop to ask. Is the sacred Australian dream of property ownership actually a financial engine, or is it a cultural trap that consumes our capital while locking us into decades of debt? To answer that, we have to look past the initial excitement of holding the keys and examine what happens after the ink dries on the contract. Picture this. You finally scrape together a deposit, sign the papers, and buy a home in a major Australian capital. On paper, you are now a property owner, building wealth with every passing month. But then comes the shock of bank amortization tables. Most first-time buyers focus entirely on the purchase price, completely overlooking the compounding monster of bank interest. Over a standard 30-year mortgage, especially in high-priced markets like Sydney or Melbourne, the total interest paid over the life of the loan can easily equal or even exceed the original purchase price of the home. You aren't just buying $1 million house, you are often paying $2 million for it by the time the bank hands you the final title deed. And the costs don't stop at the bank door. Homeownership comes with a relentless stream of unglamorous, inescapable ongoing expenses. There are council rates, state stamp duty charges upon entry, building and contents insurance, and the golden rule of property maintenance. Expect to spend 1 to 2% of the property's value every single year on upkeep. A leaking roof, a failing hot water system, or termite damage can wipe out your emergency fund overnight. This creates the psychological trap of being house poor. You own a massive valuable asset on paper, but your monthly cash flow is entirely squeezed. Every dollar goes toward the mortgage, insurance, and maintenance, leaving you with little to no surplus cash for living, traveling, or investing elsewhere. How much money quietly evaporates into interest and upkeep before a homeowner ever sees a real profit? The numbers often shock people. But what if there is an entirely different way to build wealth without being chained to a single physical structure? What happens if you skip the crushing stamp duty, avoid the 30-year mortgage, and take a completely different route? Enter rent vesting, the strategy of renting the lifestyle and location you actually want while deploying your deposit and monthly surplus cash directly into the share market, exchange-traded funds, or other liquid assets. When comparing historical performance over long periods, residential property in Australia has certainly performed well, but diversified equities on the ASX and global markets have frequently matched or outperformed it without the massive leverage risk or concentration penalty. Consider the supreme advantage of liquidity. If an emergency strikes or a new investment opportunity arises, you can liquidate a parcel of shares in a couple of days with minimal fees. Try doing that with a bricks-and-mortar home. Selling a house requires months of marketing, thousands of dollars in real estate agent commissions, legal fees, and marketing costs. Furthermore, buying a home ties your entire net worth to a single geographical coordinate. If the local economy shifts, a major employer leaves town, or undesirable neighborhood changes occur, your primary wealth-generating vehicle is stuck right there with you. Rent vesting offers radical diversification, allowing you to spread your capital across global industries, tech companies, healthcare, and infrastructure. By skipping the property stamp duty and investing your capital directly into compound growth vehicles instead, your money works for you from day one, unburdened by council rates and mortgage interest. Yet, financial spreadsheets only tell half the story. What about the way you actually live your day-to-day life? Money is ultimately a tool to buy freedom, choices, and peace of mind. This brings us to a factor that rarely shows up on a bank loan application: the hidden cost of location and career mobility. When you own a home, you are physically anchored. If a dream career opportunity opens up across town or in an entirely different state, uprooting your life becomes a logistical and financial nightmare. The transaction costs of buying and selling real estate mean that moving frequently is punishingly expensive. Renting, by contrast, provides lifestyle agility that gives you the freedom to pack up and move when life calls you elsewhere. During your peak career-building years, this physical flexibility can supercharge your earning potential. Being able to move closer to a new job hub, live in a vibrant inner-city neighborhood, or test drive a completely different lifestyle without a long-term commitment is an underrated career multiplier. Of course, renting comes with its own frustrations, dealing with property managers, routine inspections, and a nagging feeling of instability if a landlord decides to sell. But it also shields you from the structural responsibilities of being entirely on the hook when things break. Is the psychological security of owning a physical home worth sacrificing your freedom to move where life calls you? That depends entirely on what you value most. We have looked at the cultural myth, the hidden debts of homeownership, the liquid power of rent vesting, and the lifestyle value of mobility. Now, it is time to bring these contrasting strategies together into a unified framework for decision-making. There is no single correct answer for everyone, because the right choice depends heavily on your psychology, your time horizon, and your personal risk tolerance. For some people, the psychological security factor is non-negotiable. They sleep better at night knowing that no landlord can evict them, that their housing costs will eventually drop to zero when the mortgage is paid off, and that they have a permanent sanctuary no matter what happens to the broader economy. For this personality type, homeownership is an emotional fortress, and the financial trade-offs are a price they are gladly willing to pay. For others, the data-driven approach takes precedence. If you value flexibility, want to avoid massive debt, prefer diversified liquid investments over a single illiquid asset, and plan to move around for your career, renting and investing the surplus is a mathematically elite strategy. Evaluating your standing in the Australian housing landscape comes down to a simple internal audit. Are you buying a home because it genuinely aligns with your long-term life goals, or are you just following a cultural script written decades ago? Ultimately, a house is a place to live first and an investment second. Too many Australians sacrifice their entire financial youth and mental health trying to force themselves into a property market that doesn't fit their lifestyle simply because they feel society demands it. True wealth isn't just a high net worth tied up in bricks and mortar. True wealth gives you choices, flexibility, and peace of mind. Whether you decide to plant your flag in a permanent home or build your fortune through liquid markets, the most important thing is that you make the choice deliberately, eyes wide open to the trade-offs. Your future is yours to build on your own terms.